There are really only 3 ETFs that every investor needs in order to retire wealthy, enough so where you're never really going to have to worry about money ever again. Now, these 3 ETFs, or exchange traded funds, are probably ETFs that you've heard about before, and that is because they are some of the top performing ETFs that you can actually invest into. A matter of fact, one of them, should you actually get invested early enough, just far exceeds the total returns of the other 2 and will make a hefty sum more for you in retirement. However, listen up, because a lot of us investors are making some serious mistakes when it comes to investing into them, which is why I wanted to compare all 3 ETFs, share how you should go about investing into them, and then line them up side by side in terms of performance to show you through exactly why and how you should be investing into them. With that, are you ready? So I believe as we dive into each of these exchange traded funds, it's important to tackle the first question, which is, should you even invest into ETFs as opposed to just betting big and going all in on some of the top performing individual stocks? And the answer is actually quite simple. First of all, the top performing stocks of say 10, 20 years ago are certainly not today's top performers. I mean, just think about year 2000. Nvidia was just 7 years young and nowhere near the highs of today. Likewise with Amazon, Meta, Tesla, and a handful of other stocks that have taken the market by storm, which is all just going to say here for all of us that you can't accurately predict the future and forecast which stocks will be home runs and which ones to totally avoid. Therefore, betting big on ETFs, which is really an investment into a basket of holdings, substantially decreases your risk while significantly increasing your ROI should you find yourself invested in some of the top performing ETFs. So with that in mind, up first, I want to cover Vanguard's S&P 500 fund, ticker symbol VOO, which was a fund designed to track the S&P 500 index, or rather the 500 largest U.S. companies that ultimately offers a very high potential for investment growth over time. And as you can see, even marketed towards an investor who has a long-term growth goal in mind. Now, the benefit, of course, with any ETF is that holdings will get swapped in and out accordingly, meaning you really don't have to do any of the heavy lifting aside from just consistently buying more shares over time to really ramp up the return power of this fund and the others. But let's pop back into Vanguard here for the fund's characteristics to see that it has over 503 stocks in the fund currently. We're coming up with a market cap here of $247 billion and coming in with a return on equity rate of 24%, thanks to American Might, with the top 10 holdings that work out to Apple and Microsoft as the fund's largest holdings, followed by Nvidia, Amazon, Meta, Alphabet, Berkshire Hathaway, Broadcom, and Tesla. But it's spread all across sectors, with 31.4% of the fund's overall weight in tech, 13% in financials, 10% of the fund's weight safer in consumer discretionary before tapping into 11.9% in healthcare and 8.9% in communication services. Now, VOO is honestly one of the most popular and low-cost funds available to all of us investors, with an expense ratio coming in at just 0.03%, meaning you're only paying $3 per $10,000 invested into the fund annually. And for all the dividend investors out there, yes, you will be receiving a quarterly dividend with VOO as well, small but mighty, coming in at 1.26%. Though the major focus with an investment like this is the total return in long-term growth. But speaking of growth and gains, if you would have invested $10,000 into VOO 10 years ago, we would actually be talking about a 12.9% average annual return rate, meaning you would have already more than doubled your money while sitting on $33,762.58. Next up, we have the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, which made the shortlist today because of its proven track record to perform through the market highs and lows and all the bouts of volatility, and of course just continue to rise during bull runs. Now, SCHD, as you likely already know, is a dividend-oriented fund squarely focused on tracking the total return of the Dow Jones U.S. Dividend 100 Index. It often is used to actually complement a diversified portfolio, or at least should be, but many dividend investors actually either go all in on it or, based on their investment timeline, fail to recognize the setbacks with SCHD, which we're going to get to at the end of the video. Nonetheless, clicking into the fund's profile, we can in fact see that we are ultimately going to secure an investment spread across 103 holdings, which, if we scroll down, we will see those holdings are spread across sectors like financials, coming in at 17.3% of the fund's weight, healthcare, that's going to make up 15.5% of the fund, followed by consumer staples and industrials at 14.2%, and 13.3% respectively, as well as energy coming in at just 13%, which work out to the top 10 holdings coming down to Lockheed Martin, AbbVie, Home Depot, BlackRock, Coca-Cola, as well as Cisco Systems, Amgen, Verizon, Bristol-Myers, and Pepsi, which are all huge, iconic names, leaders in their industries, and known to be more defensive than not as opposed to the riskier growth stocks that are out there. But that does not stop SCHD from delivering through on strong performance, with a $10,000 investment made 10 years ago into SCHD returning $20,011 back to you, which is only about $3,000 or so less than investing into the S&P with Vanguard's VOO. Now, SCHD, of course, shells out the all-famous 3.68% dividend yield while only costing you about $6 per $10,000 invested, thanks to that low expense ratio at 0.06%. And finally, we have another Vanguard fund to break down, which is Vanguard's Information Technology Fund, ticker symbol VGT, which is just about an absolute powerhouse when it comes to growth, as it is solely focused on tracking the performance of a benchmark index measuring investment returns of the stocks within the tech sector specifically. Now, personally, I began investing into VGT because as a more risk-adverse dividend investor, I'm not interested in doing all the due diligence on tech stocks, but I certainly know that tech is where the future is, so this fund has become my go-to, and since scaling a position with it, has already been returning a hefty ROI. But clicking into the fund, you're going to find that it's made up of 318 holdings, a market cap here of $747 billion, and a solid return on equity there of roughly 42%, stemming from subsectors within the tech space, like semiconductor investments that make up 29.1% of the fund, software coming in at 21.3% of the fund's weight, hardware and storage weighting in at 19.1%, as well as application software and semiconductor or materials weighting in at 13.6% and 4.1% respectively, before further diversifying into more tech subsectors, but ultimately giving way to the top 10 holdings, which have been a force not to be reckoned with, from Apple and Nvidia as the largest two holdings, from Microsoft to Broadcom, Adobe, Salesforce, Advanced Micro Devices, Oracle, Accenture, and Cisco Systems, that then all work together to deliver some serious returns. I'm talking about a $10,000 investment made into this fund 10 years ago, allowing you to now sit on a mountain of cash totaling out to $57,351.58, which is just unheard of for a rather low expense ratio of 0.1%, while also gifting you a chunk of a dividend at a small but mighty 0.53%. Now, here's the big question. Which out of these three ETFs should you invest into? And a follow-up question, should you want to invest into each of them or pick two? How do you go about doing so? Well, the reality is that if you're a younger investor, I'm talking about 20-somethings or even into your 30s with some time to spare in the stock market, SCHD shouldn't fool you with its alluring dividend yield. It gets most investors that way. But you're really going to want to go more growth to fuel your total returns. However, if you're on the elder end, nearing retirement or already retired, then SCHD is a great fund providing you with plenty of reliability and passive income. Now, personally, I am not invested in SCHD right now for the very reason that I have so much time to actually be invested in the stock market before retiring that I want to maximize my returns by all means possible. So I would say if you're in your 20s and 30s, you really can enjoy either a 50-50 split between VOO and VGT, or if you're looking to play it safer and heavier into VOO at maybe 60 to 70% of your split. Now, if you're truly keen on SCHD and just cannot do away with the dividends, I would allow for no more than maybe 10 to 20% of the allotment. But if you're older, well, SCHD should take up a much larger chunk of your portfolio, upwards of 70 to 80 or even 90% depending on your investment profile. However, it is at this time that you'll want to create a safe buffer from volatility, so minimize the risk. Feel free to make VGT no more than maybe 10% of your portfolio. Now, you may even consider a larger chunk with the S&P, but keeping SCHD certainly as the majority. But the goal of this video was to illustrate the power of these ETFs, so I want you to see their performance side by side, with SCHD coming in with roughly $20,011 worth of your return, whereas the S&P with VOO giving you plenty of safety along with the opportunity to capture growth would have added $23,762.58 to your account, all while the tech orientation allocation with VGT would have added $47,351.58 to your bottom line. Now, past performance, as always, is never indicative of future performance, but when it comes to these three ETFs specifically, I am more than willing to imagine it's going to get pretty darn close. So in my opinion, it is really a no-brainer to forgo your desire for dividend yield to capture growth for total returns while you're young, but over time, then shift gears into more safety and more reliability, higher yield as well as you age. But I would love now to catch your thoughts here, or even if you have better ETFs in mind in terms of performance that also match the low expense ratio criteria that these funds share in common. Comment down below with all your thoughts, discover more insights right here, and of course, if you're not already subscribed to the channel, do so now so I can actually catch you in the next one.